Amazon has had a very strong performance, up 52% just over the last 12 months. In fact, over the last 10 years, this company is up more than 1,000%. And right now, we do see it trading right there at its 52-week high, which we still believe to be a very good price to buy this phenomenal company, which we see a ton of growth. Now, what we also note is that Wall Street do consider this a strong buy as well, with a buy from Seeking Alpha and a hold from Quant. Now, if you just purely look at it from a valuation perspective on the PE, you could argue on a forward basis, 43.5 does look to be expensive, but we are going to run through why we do believe this company to be a must-buy for any portfolio. First thing that we want to talk about is their earnings per share, how they've performed, what they're projecting, and what we always like to look at is over the last 4 quarters, how have they performed? Well, they've beaten every single analyst target and their own estimates. 4 out of 4, that is a very strong 100% record. And when we do look to the future, over the next 4 quarters, they are anticipating double-digit growth year on year to the earnings per share. Now, what this translates to is essentially that December 2025, if they do hit their target, that forward PE will be sitting around 34.5. Now, a lot of this does come down to whether or not you have faith in management, confidence that they will achieve these numbers, but we can clearly see just over the last 4 quarters, they have been able to beat by quite a nice margin as well. This then leads us onto their growth, which we also like quite significantly. As we can see, they get an A- on that growth grade. This is effectively comparing it to the sector median. For example, year-on-year growth, they've had 12.5% on the top line, a lot better than the sector of low single digit. In terms of forward-looking, 11.4%. As we can see, the sector just under 4%. And if you were to look at the other metrics as well on the growth, we can pretty much see that this percentage difference to the sector is much, much higher, justifying that it should be valued higher than the sector PE. But at what price it should be, we will come on to that shortly as well. And one thing we'd like to draw your attention to, earnings per share on a forward basis over the next 3 to 5 years, they're anticipating 23%, which is much higher than the sector median of 11%. So off to a great start in terms of how this company does look to have performed historically as well as the estimations. And then we move on to the profitability where they do get an A+. In terms of the gross margin, well, 48%, as we can see, sector median around 37%. Bottom line, 6.4, not too dissimilar from the sector median at 4.63, but we can still see it is better around 38%. And one of the major factors to take away from here is that cash from operations, 99.2 billion, when the sector as a whole at 279 million. So in terms of all of this wrapped up in a very mini conclusion, we get a double buy rating with the hold from Quant. Now, we didn't touch upon the valuation, but no surprise a D- given that high forward PE. Their growth A- with their profitability at A+. Now, one of the ways they are looking to increase those margins by introducing robots. What is quite interesting is this article does run through 12 of the different robotics that Amazon currently use in their warehouse. Now, you may think that, this isn't something that is going to take over their employees, but what is very interesting to note, this article just from a few months ago, it talks about how they've grown to over 750,000 robots. They are in fact the world's second largest private employer, and as we can see, they've replaced over 100,000 humans. As we said, ultimately this is going to lower their costs, which will help with increasing their profitability, which is already much higher than the sector median. Now, when we just run through very quickly some other metrics, we can see their free cash flows over the long term have been increasing. In fact, over the next 12 months, nearly double is the anticipation from the full year of 2023. Their sales growth looking very strong, double-digit increases every single year, which is a good sign that this company is still able to increase their revenue, whilst, as we can clearly see here, growing at a very, very rapid rate. In terms of the ROICs, as always, we do want to see 10% as a minimum. We don't get the consistency, but what is nice to note, from the lows of 2022, it has started to rebound. 13% is also a nice thing to see on a trailing 12-month basis. We then take a look at margins. Now, as always, with the operating side, we want a minimum of 12%. They haven't achieved that, but what we can see is operating efficiency, where it has increased over the longer term. Nice to note, again, from the lows of 2022, it has increased 8% on a trailing 12-month basis. And free cash flow margins, minimum of 5%. Granted, we do see 2 years of negative free cash flow. Nice to report 6% in 23, and again, nice increase on the trailing 12-month. So we should expect some very strong results for their full year 2024 accounts. And when we look at the net debt to EBITDA, effectively correlating to their balance sheet strength, what this shows us, 2023, 0.61 years, to pay off all of their debt net of cash on hand. They do have a very strong balance sheet. We then move on to their latest quarterly report, and essentially there is a lot of growth that has been happening. Well, these numbers are on a trailing 12-month basis, but as we can see quarter on quarter, there is that increase on the revenue, always a great sign, but that essential increase doesn't stop there. The same is to be said there for their operating income, as we can see up 255% on a year-on-year basis. Again, net income grown even faster, actually 778%. And the free cash flow is something that is very important to us on this channel, as we do want to see that increasing over the longer term. Whilst we do note their negative that we touched upon just a few minutes ago, we can see it is now moving in the right direction and growing at a very rapid rate. Note that a trailing 12-month for Q1 is around 50 billion, and that is important when we do come to look at the discounted cash flow model. Now, a few things that we need to talk about is insider ownership. It is fairly high, around 11%, and we do see 10 insiders selling over the last year for around 5.6 billion. When we look at the specific quarter, we see in the more recent quarter of Q3, just under 700,000 worth of sales, Q2 13 million, and in fact quarter 1 5.51 billion. When we take a look at who these individuals are and when the latest was, we can in fact see the CEO did sell at the beginning of this month around 3,500 shares for that $700,000 amount. Now, one thing we would say is this isn't necessarily a bearish signal. Insiders sell for many different reasons, but as always, for the transparency, we also want to make it clear that Jeff Bezos is also looking to offload around 5 billion worth of Amazon stock, but do also factor in that he still does hold a fairly significant stake of around 9% in this company. Now, when we take a look at the institutions, around 72% ownership, 23 billion worth of sales, but a lot more buying, 73 billion, in fact, nearly 4 times as much. When we look at quarter 2, now the full data set hasn't been received, so we see 15 million buys, 15 million sales, but the general trend of Amazon over the last few quarters, in fact, over the last few years, is that there is a lot more buying by these institutions than there has been selling. Now, the one thing that we want to say from this is you should always do your own due diligence, never copy what institutions, what the insiders do, and always form your own opinions before you execute. Now, we do just want to make it clear that on Monday we will be releasing our Dividend King free spreadsheet, which will run through every single one of the 49. Also talk about the upside that we see, whether or not we believe it to be undervalued. For those that are essentially signed up to the free weekly newsletter, you will gain access to that, as we said, on Monday, but you can also gain access by reading all of these articles right now. As we said, free instant access by clicking on that pinned comment below. So now let's jump into the valuation of Amazon stock, and what we would say is in our own intrinsic value, we do arrive at $223. When we do take a look at the DCF model, then we do have that average growth at -3%, although it is skewed due to the fact it's gone from negative to positive, and as we have seen just over the last few quarters, a lot of free cash flow growth. We have a low, medium, and high rate, of which we have used the medium rate of 20%. In conjunction with the discount rate, we get the present value of those future free cash flows and terminal value. We add together with the cash, subtract total debt, get the equity value, divide by those shares outstanding, and as we can see, an undervaluation signal. Now, bear in mind, this is subjective, and you can grab a copy of this model running your own numbers through, and you can grab that by clicking on the pinned comment below. But what we are using is that medium rate. Now, there will be people that will say that is very conservative. Amazon are looking to ramp up their free cash flows dramatically over the next few years. So for those at 30%, as we can see, the intrinsic value would be around $441, which is more than double that current trading price. Now, for those that believe 25%, well, we have used that as the higher rate. We can see that would give a price of $316 with upside of 59%. As always, on this channel, we do like to be conservative, and we do believe, in fact, the 20% we're using now is more on the conservative element, but as always, that is what we like to do on this channel. So that's where we arrived at our intrinsic value, and with the current price at $198, what we always like to do is start off with a 10% margin of safety, which we do execute on if it does meet the 3 golden criteria. That is a wide moat, strong financial metrics, and good forward-looking data, which we believe right now for Amazon would be around that $200 mark. So right now, a 10% MOS level does look like this is a buy for Amazon right now. If you did want a higher MOS, well, at 15%, it would be around 190. At 20%, around 178. So at that 10% level, what we can see then, that Wall Street is indicating it at buy as well. Their price target of $222 isn't also dissimilar from our intrinsic value, giving 12% upside. As always though, do let us know your thoughts in the comments below. Is Amazon one you are looking to add? Maybe it's not because you hold it in an ETF, or for whatever reason, do let us know your thoughts below. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.